Every tax season, I had the same conversation with a new client. They tell me they did a backdoor Roth IRA by following an online tutorial and felt great about it. Then, a few months later, their tax software flags a big surprise. A balance is due. They owe thousands of dollars in taxes they didn't see coming due to an often overlooked and misunderstood rule. If you have money sitting in a traditional IRA from an old 401k rollover and you're planning to do the backdoor Roth, this video could save you from a very expensive mistake. I'm Kevin Pira, a certified financial planner and founder of Pira Wealth Management. Let's get into it. If you don't already know, the Roth IRA is one of the best accounts in the entire tax code. You contribute after-tax money, it grows tax-free, and qualified withdrawals in retirement are also tax-free. That is rare and very powerful combination. But there is a catch. If you earn too much, you cannot directly contribute to that Roth. In 2026, Roth IRA contributions start phasing out around a modified adjusted gross income of $153,000 for a single filer and $242,000 for married filing jointly. Above those ranges, the front door is closed and you need a workaround. The backdoor Roth is your solution. It has two steps. Step one, you make a non-deductible contribution to a traditional IRA. There's no income limitation on that. And then step two, you convert that traditional IRA balance to a Roth IRA. Conversions also have no income limit. If that sounds like a loophole, well, it kind of is. Congress has discussed closing it several times over the years, but as of right now, it remains a valid and widely on paper. The mechanics are simple. For 2026, you contribute $7,500, convert it, and you're done. And for some people, it really is that simple, unless you have one specific thing in your financial life. And that is where the pro rata rule comes in. Here's the part that trips up a lot of people. When you convert, the IRS does not let you pick and choose which dollars you are converting. They look at every traditional IRA you own and treat them as one big combined pot. That includes traditional IRAs, SEP IRAs, rollover IRAs, simple IRAs, all of it gets aggregated. Now, your spouse's IRAs are not included in your calculation, and pro rata is applied per person. Generally excluded from the calculation are your Roth IRAs, inherited IRAs that remain properly titled as inherited IRAs, and your current employer plans like your 401ks and your 403bs. You likely have one of these accounts out there if you've done a rollover from a previous employer's 401k or 403b, so listen up. So, the IRS asks a simple question. What percentage of that big pot is after-tax money? Whatever that percentage is the percentage of your conversion that comes out tax-free. The rest is fully taxable as ordinary income. This is the pro rata rule, and you cannot opt out of it. You do not get to tell the IRS, I only want to convert the new after-tax money, so you have to understand the rule very clearly. Let me give you an example. Meet Sarah. Sarah makes $250,000 a year as a software engineer. So her income is well over the Roth contribution limit to directly contribute to the Roth IRA, so she decides to do a backdoor Roth. She contributes $7,500, the 2026 limit, as a non-deductible contribution to a new traditional IRA. The paperwork was filed correctly, step one is done. But here's the part that the online tutorial never mentioned. Sarah also has a traditional IRA elsewhere from a 401k rollover at her previous job. That traditional IRA has $92,500 in it, and it's all pre-tax money. So when the IRS looks at Sarah's situation on December 31st, her total balance across all of her traditional IRAs is $100,000. Of that, $7,500 is after-tax basis, and $92,500 is pre-tax. Here's the math. $7,500 divided by $100,000 is 7.5%. So when Sarah goes and converts her $7,500 to a Roth, only 7.5% of that conversion comes out tax-free. That is about $560. That other portion, just under $7,000, is fully taxable as ordinary income. At Sarah's marginal federal tax bracket of 32%, that conversion just generated roughly $2,200 in a surprise federal tax. For a $7,500 contribution, that is roughly a 1/3 effective tax cost on money she thought was going into the Roth cleanly. And it gets worse. That basis she did not get to use It's still in there, trapped inside her traditional IRA, and every conversion she does in the future will face the same math until she drains down that pre-tax balance or changes her strategy entirely. To recap, the IRS does not care that her $7,500 contribution itself was after-tax money. They care what percent of all of your IRA money is after tax. This is the mistake I see every tax season that comes with a surprise tax bill. So, what do you do if you have pre-tax money in a traditional, SEP, simple, or rollover IRA, but you still want to do the backdoor Roth? Well, you realistically have three options. Option one is the reverse rollover. This is the move most people have no clue about. If your current employer's 401k accepts incoming rollovers, and many do, but not all, you may be able to move those pre-tax dollars from that IRA into that 401k before December 31st. That gets those dollars out of the pro rata rule calculation because current 401k balances are not counted. However, you need to remember this critical timing component before you do this. The pro rata calculation is based on your IRA balances on December 31st of your conversion year. So the reverse rollover has to be completed by year end, not by tax day in April, by December 31st. And remember, rollovers can take weeks to process between custodians. So start this in the summer or the early fall. Don't wait until December. Option two, you just skip it and you use other tax advantage strategies. If the reverse rollover is not available, then you can look at other high value strategies that could benefit you. You could look into the mega backdoor Roth, HSA optimization, or even a taxable brokerage account with a tax loss harvesting. If you want someone like me to look into your specific situation, link is in the description below. Option three, you convert the whole traditional IRA to a Roth in one shot and you pay the tax. So this works best in those low income years because you want to reduce that tax. And the difference between converting in your peak earning years versus a gap year can easily be $10,000 or more in federal tax. So you have to know what you're doing here. This is what proper tax planning really pays for, and this is where real value is delivered to our clients. For most high earner, this tends to be a multi-year strategy and not just a one-time move. Every year you make a non-deductible traditional IRA contribution, you need to file Form 8606 with your tax return. This form tracks your after-tax basis, which is the money you've already paid tax on. If you skip it, there is a $50 penalty per missed form, but really the penalty is not the big issue here. Without that paper trail, you may have a hard time proving to the IRS that part of your IRA was already taxed, which means your after-tax basis can effectively get taxed a second time on the way out. I have seen Form 8606 missed more times than I can count. So if you've been doing the backdoor Roth without filing this form, talk to a tax professional or drop us a message. The good news is that it is fixable, but it's a lot less headache to do it right from the start. Remember, the pro rata rule is only a problem for a specific profile, someone who has meaningful pre-tax money sitting in a traditional, rollover, SEP, or simple IRA. If your combined balance in all of those account types is zero as of December 31st of your conversion year, the backdoor Roth is clean. The full $7,500 converts tax-free, just the way you expect. I recommend keeping a clean track record of all of your accounts out there and keeping note of important events and dates like the years you do a 401k rollover. Here is what I want you to take away from this video. Before you do a backdoor Roth, do a December 31st IRA check. Check the combined year-end balance of every traditional, rollover, SEP, and simple IRA that you own. If it's zero, you're clear. If it's not zero, either run the pro rata math, execute a reverse rollover into your 401k before year end, or talk to a planner before you click the convert button. This is exactly the kind of mistake that is easy to catch before it happens and kind of expensive to fix it afterwards. If you want a second set of eyes to review your retirement tax strategy, go ahead and click the link in the description below to book a call with me and my team here at Pira Wealth Management because this is the exact type of work that we do. And if this video helped you in any way, please consider subscribing to the channel and leaving a like. More of this content is on the way. I'll see you in the next one. Take care.